Because what we had here was a pretty wide range where Bitcoin was trading all the way up between here and here. We had high volume here, high volume in this area. And as we reached towards the top of this, you could see that if it were to break out, maybe I go up one more and try and show some of this. So if we look at it from here, you can see it a little bit better. And pull it across so we don't want to look at any of the trading that happened after. You can see that as price got up towards this level where we had very high volume, as soon as it was able to get up above this level, it moved pretty fast through a relatively low volume area and headed up towards where there was an area of low liquidity above a key high to push into it. And then either, as you know, if you've seen a balance and imbalance lesson, at these areas you're either going to reject strongly and come back into range, or you're going to push higher rapidly with big green candles. So obviously in this instance, we got the former, where it rejected back into range. And then we started to move down, creating some gaps in volume here. But really with this type of move that's happened, there's not nothing really significant that you could take from it. But you want to see things like this, where you have this injection of volume, right? So it's all relative as well. And you're trading on a low time frame, so this is covering about 1, 2, 3, 4. This whole view covers 6 or 7 days. So you're looking at relative volume. It doesn't matter what's happening, on a month by month basis, where you can see that volume steadily increasing as we're going up. And we were reaching to an area that if we got above this high, you could estimate that there was going to be an area of a pocket of low volume, pocket of liquidity, a pocket of low liquidity, sorry. So what is the deduction you would make from that? You'd say, right, when we were trading all the way down here, volume was extremely low. As we started to rise, volume was increasing along with it. Increasing. Kind of, it went a little bit flat here, but then we got an injection of volume into this area and another push with a volume spike. So then after you see the kind of climactic move, which was a push up to here, you should have been looking for a short if we didn't see a further extension of the uptrend. Because you go from a low volume, relatively low liquidity environment into a high volume, high liquidity, because you've got volume increasing, but price finding both support and resistance. That means that you've high volume, but the walls either side, buys and sells, are pretty strong. So you can say it's high liquidity. Then we move right up. You have to always ask yourself, why is price moving? Where is it trying to get to, and what's the purpose for it? Well, the reason price moves up is in order to find enough liquidity so that it can turn back and move down. The only question is when that's going to happen. It's never going to go up forever. It's never going to go down forever. So one of the surest ways of spotting a top or a bottom is when you have a large volume spike, so a relatively large volume spike, which we had here, the highest volume in terms of a cluster of volume. It was much higher than anything that preceded it, and that was into this area. And then so you observe a little bit more. We've got a push on lower volume. So normally, if it's going to keep going up, volume should keep rising. If you get this next push with lower volume than the previous one, you can see that there's less activity. There's less buyers willing to push higher, and they're meeting resistance and dropping back more easily. So here we had high volume that pushed price up, and price stayed up there. Then we had a lower volume push that got rejected immediately. So what does that tell you? That means, imagine I had to use 1,000 BTC to move all this. 1,000 BTC, and the market held it, and it didn't reject. Then we had, in relative terms, probably half of that, if even. 500 BTC. Now, the same logic as before, it should keep going up. But no, the 500 BTC gets rejected. That will tell you that the move is weakening. The uptrend is getting weaker, and we're likely to reverse. Now then you just combine that with your other factors, once you see price break down to here, so it broke below this old consolidation and then began to chop around, this is now very likely to be distribution. You see some high volume, another high volume attempt to push up, gets rejected again, and then you can start hunting for shorts, looking up for your other setups. But you know that because of this move, the entire move up, in tandem with moving through a low liquidity area here, and the high volume, which led to no extension, no further continuation, you can deduce we're more likely to be distributing than accumulating, and we're going to go lower and position yourself for some shorts. So that's a high volume, low liquidity move, but you're looking for high volatility. So that's price moving a lot in a short space of time. So the first kind of signal for this was this super high volatility move here, right? So when that happens, and then we have a period of low volatility where it's not moving much, there's low volume, and then you start to get a little bit more of an injection of volatility, you can assume that we're going to see a bit of a high volume, low liquidity period of price action, because when you get the big move, you typically have a bit of a lull after it before the next big move. The big move like this, think of it in psychological terms. We dip down, we had a massive pump up, we then can fully retrace it. What does that create? It creates uncertainty, all right? Uncertainty in market participants. Don't confuse uncertainty for an unexpected move, but we'll cover both of them. So typically, news events are times of high volume, low liquidity moves, volatile moves. The high volume, low liquidity is essentially the conditions that are needed for volatility. And we are traders and we want to trade volatility. So news events, it can be both unexpected and expected. You can have FOMC, which is the Federal Reserve meetings, where they talk about setting rates, monetary policy, etc. They are known events, but they're still impactful news events. You've got the CPI, Consumer Price Index. It's a measure of inflation. The CPI released monthly. We know exactly when it's going to be released. It's a known event, but it still causes some volatility. Unexpected news events are the real market movers. Things like the Ukraine war, things like COVID, they were unexpected. And when I say unexpected, it doesn't mean that nobody knew. It just means that the vast majority of market participants didn't know. Always there is someone who knows before the rest. There was always that group of people who knew that Russia was going to invade Ukraine before they invaded. But it's still an unexpected event, because you have to look at 99% of the market participants. Did they expect it? The reason why these unexpected moves get a greater reaction is not because of the news itself. So you hear me say this all the time, that news does not drive price. Traders and liquidity are what drives price, right? So the buying and selling in the market from traders and from whoever, general market participants, market makers, hedge funds, smart money, whales, everyone, the amalgamation of everyone is what actually moves the markets. The reason why unexpected news moves it more than expected news is because it creates uncertainty and pulled liquidity. So if market makers and others have an event that shocks even them, they're likely to adopt a defensive stance, meaning they will reduce their exposure to the market by taking orders off the books. That can be both buying and selling. But the idea is, if you broadly believe that Bitcoin is always trading at something like its fair value for that moment, and so you're saying that right now, Bitcoin is trading at 20K, give or take, and if it's trading at 20K, give or take, with the current news that we have available to us, then suddenly Russia invades Ukraine. Well, this is no longer valid. This fair value, in air quotes, was before Russia invaded Ukraine. What happens when they hear about Russia invading Ukraine? People are like, well, I'm not happy to be buying and selling around 20 anymore. Just be safe. I'm going to remove my buy orders. And maybe I'm going to sell some of the stuff I have because I don't know if it's going to go lower. So you have a double hit on liquidity. You've got them removing the buy orders, which creates less. If you imagine that wall like I showed you, like here, they remove the buy orders, meaning this wall gets smaller and smaller and smaller, and they probably sell a little bit, so they're pushing the price down into a thinner book, which is how you see these moves like that, until eventually it levels off again and people start to buy and sell at a price they deem to be the new fair value. So at 20k, Bitcoin was trading. Then people say, then the war happens or whatever, it drops to 16k. And people are like, okay, it's dropped far enough, I'm happy to buy and sell it. Price is down by 40% or 30%. Okay, I think that's a fair reaction to the massive news we had that could be, changing the landscape of the world. That's how it works. But it all comes down to the level of uncertainty in the market and market participants. Okay, so if you don't know what's going to happen, the smart thing to do is to get out of the market. All right, so if news comes out and you don't know how that news is going to affect things, it's better to stand back and let it develop. But when everybody stands back at once, there's no room in the market for support, it goes down. So that's why the Ukraine war affected markets more than the FOMC meeting, right? Because the FOMC meetings are known events. We know the time, we know the date, and people are projecting what might happen. The war, obviously, was unexpected. COVID, obviously, was unexpected. That's why they call it Black Swan. So in terms of what you're looking out for, you're looking out for these high volume and low liquidity areas. So this is where a lot of people get it wrong. When you hear things like Ukraine war, COVID, a massive CPI miss, where people think it's going to be 6% and it ends up being 8%, the forecasts are all wrong. That is when you should be looking to trade. You're a trader. You need volatility. You cannot trade in areas like this. You can't trade when it's like this, going sideways on low volatility. This went like this for like 2 days. You can't do it. You need volatility, all right? So when you start getting these type of moves, big move up, move down, big moves up, and retracements of them, that's when you can trade. That's what you want to be looking for. The other thing, if you want to be a little bit more anticipatory, or just to know when you might get a good mean reversion opportunity, right? So you've heard me talk about this in the last lesson, is just still a low liquidity environment, because we always want low liquidity. This time, we're looking at low volume, low liquidity. You basically don't want to have high liquidity if you're trading, because price will not move far. You want to see when price moves too far for the amount of liquidity that there was and on low volume. If you see that, that's a good mean reversion opportunity. So touch on this now quickly. If price moves, it's going like this, and then it gets a big move up, but at the same time, volume, let's say this is the volume bar, volume was fairly steady, and it went up a bit, but not a lot. You're like, okay, well, why was it moving like this? Why was it moving sideways and then a big move up, but with a relatively low volume increase? That tells you it was low liquidity that did it. All right, so I'll get an example on the chart here. That was a big volume spike, so that's not super relevant. That one was more impactful. But here, good example. Price going around, kind of roughly at this level. Yeah, volume, 3 touches. Here it's just going sideways. Then all of a sudden, with not very much volume, a small increase, we get a pretty big gap down right down into this area. We see a pickup in volume, but still not significantly above this line. So the volume that took us down into here was not that much more significant than what was keeping us up here. So as you could see, you could then be saying, all right, this move down was on fairly low volume. A retracement back to retest it is quite likely. We obviously got that and then some before the market continued to move. So when it went down like this, and you saw it went down on fairly low volume, always be sure to check a couple of exchanges though. Don't just go off Coinbase. Look at FTX, look at Binance as well. If they all had relatively low volume to move this down, you can say, okay, this move was inefficient, because you can see big red candles, white candles on this, but they're red candles. Big red candles down, no bounce. All right, I'm going to look for longs if I get a setup, because I know the chances are we're going to go back up and retest that, which we did. And you can see this time and time again. low volume moves, where it's a low volume move, but the candles move a lot, that's when you want to start looking for a retest or a retracement. This move was fairly efficient up to here. Again, all pretty efficient where it's going up and down in waves. But you have a gap down like this, drop down, pretty high. I mean, I would say that's relatively high volume for this. Even then, we still got the retest. But this is the best example of a low volume, low liquidity move that then retraced for a retest. So as you can see with scalping, like I always say, it's about reacting. It's not about anticipating. You want to let the move happen, then analyze the move and say, should that move have happened? And if the answer is no, then you can set up a trade in the other direction for a retest. It's exactly what happened in this part here. Big move down on low volume. You'd ask yourself, should that move down have really happened? I think no. Okay, I'm going to look for a long if I get a setup because I think we go back up. If this big move down was on high volume, maybe you wouldn't have taken the long. You don't automatically take a long just because it moves down like that. If we go back further, you can see that this move started with a high volume. So we're going low volume for over a week. All right, fairly low volume. Then we got this move here where we really lost the support at 25. High volume, high volume. Lots of selling, selling all the way down. Continued selling. So this cluster, all of this, that's a move that you don't want to counter trade. You do not want to be going long saying, oh, we have to go back and test 25 right away, because that's high volume. That's going to be, think of the volume again as your resistance. The higher that volume is, the harder it's going to be to break back above it when you revisit. Especially if, when you come back to it, like we did here, we came back up to test it, but the volume was nowhere near as much as what was here. In totality, this volume spike was much higher, this whole block. We came back up, couldn't get through it. Look at the second set of conditions that we would look for. Low volume, low liquidity precedes big moves. Sideways before sudden catalyst. Now this is not something that you're going to necessarily try and trade. I just said a moment ago, scalping is about being reactionary, not anticipating. So unless you know the news is coming, I wouldn't do it. Low volume, high volatility move. And you want to learn to spot this. All right, so this is something that's worth learning how to spot. There's a good example of it. Well, there's a decent example of it here. Again, where we had a big move. The part that preceded it was here. Again, relatively low volume down here. Nothing crazy. You could also say this. Relatively low volume. Then a big move. Relatively low volume, then a massive move. This was a high volume spike, so it kind of negates it a little bit. What you're looking for is low volume and low liquidity. But the idea is very simple. People are only interested in a market that moves. So if the market's going like this for 3 or 4 days, what does the average person do? They say, all right, I'm going to buy it if it goes here. I'm going to sell it if it goes here. But otherwise, I'm not going to do anything. So what do they start to do? They start to remove their liquidity. If you imagine price went like this for a week, okay? Just went in a tight range for a week. And on one end, you have the sell orders. You see the sell orders? They would go something like this. If you had a block of sell orders and a block of buy orders, just think about how the market is. Whenever the market's quiet, think about how you react to it. What do? Do you get more interested or less interested? You get less interested. So imagine this top left-hand corner represents 100% of all sell orders on the first day. By the time you get to the 7th day of going sideways, this is how much liquidity is left. Because over time, people get tired of it. Same thing, 100% of buy orders. Over time, it goes way down. Because as the market has less activity, it also attracts less activity. It's kind of the concept of reflexivity just applied to market activity. The more a market moves, the more people want to play in the market, the more the market continues to move. It's self-fulfilling. The less a market moves, the less people want to play in that market, the less the market moves. Again, self-fulfilling. So this is what market makers do on a weekend typically. You'll see that a weekend, and this was a weekend move, I believe, at least part of it. They will pin the price at a very, very tight range between 18.9 and 19.4. That's not tradable. A $500 range on Bitcoin is not tradable. They pin it till eventually something gives and it breaks one way or the other. So you get this big spike down, liquidate some people, we bounce back up, we go up, we take out some of the highs. That's because over this period here, the liquidity on the books was like this, dropping. Then suddenly it took nothing to make it move. Relatively small volume to spike it down and liquidate a lot of people. Low volume, low liquidity. Easy to spot. If you look at any weekend, you'll typically see low volume, low liquidity. Now you can't tell when it's going to make a move. You can't just say, well, it's low volume, low liquidity, so I'm going to go long or short. But what you'll see is, if you have one of these type of conditions, which low volume, low liquidity, and then you get a sudden catalyst. So, a FUD news story about such and such country banning crypto or banning Bitcoin again. China bans crypto for the millionth time, or unexpected news, war, things like that. Not things like CPR, FOMC, but like COVID, like things like that. Scary things, or it's typically bad news. Occasionally you get surprised with good news that spikes price up. It's MicroStrategy buying or Tesla buying Bitcoin back whenever things are a bit more bullish. Those are also the same thing, sideways before a sudden catalyst. And you see a low volume but high volatility move. So you'll see price move strong in one direction, but not on really significant volume. That's one that you can trade as a mean reversion. So trade it back in direction, right? The opposite way, like this. Low volume, low liquidity, because we went sideways for long enough that the books got thinner and thinner and thinner. Suddenly we broke. You're like, okay, that wasn't super significant volume. Maybe there was some FUD news story, but nothing too bad. I'm going to go long, trade it back. So you want to be looking out for those type of moves all the time. Final thing we'll talk about in terms of liquidity is spotting it on a chart in terms of zones and areas. And simply what you want to do is use pure price action plus time. If I look at this, I'll go to a clean chart. If we're looking at this now, you simply mark the most recent top, most recent bottom, and continue back like that. So you don't mark these, obviously, because they've been taken. The most recent untested highs and lows. We've got one back here. What you want to look at is the time in between them. So with this one, the most recent top was 3 days ago. Most recent bottom was 10 days ago. The next big bottom was 22 days ago. And the top preceded it 25 days ago. So you're looking at this in terms of trading. You put more significance in terms of the amounts of liquidity that will be above and below each of those based upon how long ago they were. So if we visualize it, the liquidity below here is going to be like that, if you imagine it. This is just a visualize. I'm not saying that's how deep the liquidity will be, but compared to this one, where the liquidity will be like this, just to make it easier to visualize. So a move down into this one will be more significant. A move up into this area will probably have a bit of resistance like that. But above this key high, where there was a massive amount of volume transacted before, you're going to see more massive volume, key high, big wall, smaller wall, small wall, big wall. That means the reactions you can expect at each should be, in general, relative to the level and how long it has been since we ran it. So, for example, if we come down into here, and we run through this level, and we do come back inside and hold, you don't expect that to be a move that will take us all the way up to here, because it's not a very significant low. The much more significant reaction should be if we break below the old low that has a lot of people getting liquidated, a lot of stop losses, meaning that if the bulls can regain control and bounce it back into range, there's a lot of people trapped here, and we can potentially go much higher. We could even go all the way up to take out that high. That's often why you see at key levels, at key points in the market where you have a long range. If you have a long accumulation like this, if we do end up accumulating sideways in this, you'll often see a sweep at the bottom before a final move up, sweep out the high. And that's where you can see these longer term reaccumulations that happen, where you get significant moves to either side before eventually it chooses a direction. Maybe it's down, Maybe it's up. Who knows? But what you want to look at is how long has it been since we ran that low? How long has it been since we ran that high? And base your assumptions about liquidity on that. Because again, that's all it is. It's just assumptions. You can open your order books right now. I mean, you can go to the order books and check how much is at 17.5, how much is at 23, which is here. You can see, for example, I think the Coinbase was a decent one. Here, if we open it to 50, you can see all the way down. All right, so 20 up to 23k, above 23k. You know, we've got not super significant, not very high liquidity above 23k on Coinbase, but below, down at that 17.5 level, the key low that we're at, we've cumulatively thousands of BTC down at each level beneath. So you could expect a little bit of support to happen at those areas potentially. Or again, why you need to keep watching it is the liquidity more significant because we're moving down towards it. And if we started to move up, so if we made a move back above 21k in this example, would you then look at it and see suddenly liquidity starts to populate the books again and the sell walls begin to stack up rather than the buy walls? That's also important to note because this is fluid. It's always moving. It's ever changing. You can't take an assumption based upon what's just happened recently. You have to look at it in totality and constantly be updating your view of it. So anyway, that's an overview of liquidity, what it is, how it works, how it varies, like how it differs from volume, how you can measure it, how you can use it to trade. It will help you in confluence with other factors to choose better ways, enter and exit as a scalper, to learn that when you see these moves, you know, we're always looking for gaps in the chart. So when you see a big move down or a big move up, okay, am I looking out for things to show resistance in terms of liquidity and I can trade it back down? Same thing, drops down, can I trade it the other direction? That's what you're looking for. You're looking to see a move happen and then trade in the opposite direction to it. So finish it here. That's module 3, lesson 3 for liquidity, done.